You think REITs are boring, little dividend machines for people who hate excitement. But in this case file, boring is the disguise. Because the same legal loophole that let ordinary people buy pieces of skyscrapers also created a quiet hunting ground where institutions feast. Retail panics, and wealth changes hands without headlines. If you want the rest of this investigation, how a simple $10 seed can become a rent-spitting engine over decades, subscribe now and keep listening. Because the twist isn't the money, it's who's been pushing you away from it. We go back to Cleveland, late 1960s, not to a trading floor but to a table. A handful of investors sit with a document that looks harmless, dry, gray, legal language, no fireworks, no champagne, but this paper is a key. Before this key existed, commercial real estate was a locked room. You didn't invest in malls, offices, and apartment complexes unless you had connections, lawyers, and a suitcase of capital. Most people didn't even know the room existed. They only saw the rent checks flowing upward like gravity was reversed. The wealthy had their own private trusts long before anyone used the word democratize. They pooled money like families pool secrets. They bought properties the public could never touch. They collected rent, refinanced, collected more rent, and passed the whole machine down like a family heirloom that printed stability. The average person couldn't join because the minimum buy-in was basically a wall. Not a wall you climb, one you're born behind. Then the government created something that looked like fairness but was really a strategic move. A structure that said, in essence, if you act like a pass-through, if you pay out most of your taxable income, you don't get taxed like a regular corporation. It wasn't charity, it was a deal, a bargain that turned real estate ownership into something that could be sliced into shares, traded, and, most importantly, sold to the public in a way the public could understand. On paper, it was simple. In practice, it was dangerous for the old gatekeepers. Because a simple vehicle is a threat to anyone who profits from complexity. If regular people could buy real estate like a stock, what happens to the whisper networks, the insider partnerships, the private placements, the expensive access that was really just a toll booth? When the tool is simple, the toll collector loses power. For years, REITs existed like a forgotten exit sign in a hallway nobody walked. Wall Street treated them like the kid who shows up to a suit and tie party wearing work boots. Unsophisticated, they said, interest rate sensitive, not real investing. It wasn't that REITs didn't work. It's that REITs worked too cleanly, too transparent, like a machine that reveals the trick. And people who sell mystery hate a trick that anyone can learn. Then the first big crack in the wall appeared, the late 1980s. A banking wound that spread quietly until it didn't. The savings and loan crisis didn't just topple institutions, it flooded the market with distressed real estate like a ship dumping cargo to stay afloat. Buildings sat empty, projects died mid-sentence, and a government cleanup machine started holding mountains of assets nobody wanted to admit were suddenly cheap. Here's the part most people miss. Crises don't destroy everything. They rearrange ownership. When property values collapsed, institutions didn't see disaster. They saw an auction. Premium assets, real locations, real buildings, real rent potential, available at prices that felt like misprints. But they needed a vehicle that could swallow massive real estate and still attract smaller capital without scaring it away. That's when REITs stopped being a legal curiosity and became a weapon. A container, a public wrapper around private-grade assets. You could now own a slice of Manhattan office space or a Texas shopping center without ever shaking a developer's hand. And the people who understood that shift early weren't lucky, they were attentive. They watched the wreckage and recognized a transfer of future rent streams into new hands. Some of those early REIT investors saw returns that sound like exaggerations at a dinner table, multiples over decades. Dividends dripping in the background like a faucet nobody bothered to turn off. But this case file isn't a fairy tale. Because the same era also produced bankruptcies, dividend cuts, and REITs that were really just marketing boxes for mediocre assets. The difference between generational wealth and a slow bleed came down to a single detective question. What kind of rent are you buying, and how hard is it for the tenant to leave? In every serious investigation, you stop staring at the headlines and you start tracking the cash flow. REITs are not stories about buildings. They're stories about contracts, who signs them, how long they last, what happens when inflation bites, and how many ways a tenant can escape when times get tough. The public looks at a dividend yield and thinks it's a reward. Institutions look at a dividend yield and ask, is this payment protected by something structural? Or is it bait hanging over a trapdoor? So I built a simple suspect board, 3 faces, 3 motives, 3 different kinds of rent. The first suspect is the one everyone recognizes, the monthly payer. It looks safe, it speaks softly, it rarely makes the news. The second suspect is louder, the warehouse king, a machine tied to the movement of goods, the pulse of commerce, the rise of next-day delivery. The third suspect is the strangest, the data fortress, a landlord of invisible reality, collecting rent from the digital world the way old landlords collected rent from busy streets. But before we name names, we need one more clue: why people keep getting REITs wrong. Most investors treat REITs like a slot machine that pays monthly. They chase the highest yield the way tired people chase the nearest coffee. That mindset is how you end up owning the weakest tenants, the worst buildings, and the most fragile balance sheets, because the highest yield is often the market screaming, something here is unsafe. The correct approach is almost annoyingly boring, which is why it works. You're not hunting for the highest yield. You're hunting for the best triangle: reliable rent, rent that can grow, and a management team that doesn't treat shareholders like an ATM. In REIT language, the heartbeat you want is FFO and AFFO, cash flow measures that strip away accounting illusions and show you what the properties actually produce after reality takes its cut. Here's the framework the wealthy use when they don't want to admit they're using it. They choose REITs the way they choose cities. They pick locations where demand is stubborn and supply is limited. They pick tenants who can't simply pack up and leave. They pick lease structures that push costs away from the landlord and onto the occupant. And they pick management teams that can refinance debt without begging. When those 4 align, time becomes your accomplice. Now the monthly payer enters the room. The name is almost comedic in its simplicity: Realty Income, ticker, 01 letter, 1 promise, 1 brand that says, we pay you while you wait. It's the kind of company that doesn't sell excitement. It sells consistency. And consistency is the quiet ingredient behind most fortunes that last longer than 1 generation. The public hears retail properties and imagines dying malls and empty storefronts. That's the first illusion. This company's core isn't built on fashion trends or luxury shopping. It's built on necessity: stores people still visit when they're anxious, broke, or tired, pharmacy, convenience, discount, quick service, home repair, the kind of places that stay lit because life keeps happening even when markets don't. Then comes the second illusion: maintenance. Most new landlords learn the hard way that rent isn't pure profit. Roofs leak, taxes rise, parking lots crack, but this monthly payer often uses a structure that flips that pain onto the tenant. Triple net leases: the tenant pays the property tax, insurance, and many maintenance obligations. In simple terms, the landlord collects rent while the tenant carries more of the real-world mess. You can feel why institutions like this. It's not just income, it's predictable income. Predictability lets you plan. Planning lets you stay calm during crashes. And calm is what lets you buy when everyone else is selling. The monthly payer is not designed to make you rich overnight. It's designed to keep you from doing something stupid when volatility tries to turn your brain into an emergency siren. But every suspect has weaknesses. The monthly payer's weakness is its reputation as safe. When too many people decide something is safe, they overpay for it, and when rates rise, anything priced like a bond can get punished like a bond. That doesn't break the business, but it can break impatient investors. The institution sees the dip and thinks, accumulation. The amateur sees the dip and thinks, I was wrong. And that moment, right there, is one of the main transfer points of wealth. The warehouse king doesn't walk into the room like a banker. It walks in like a highway at midnight: quiet power, constant motion, no applause. Its name is Prologis, ticker, PLD. If the monthly payer is your anchor, the warehouse king is your engine. Because it owns the kind of real estate that doesn't look glamorous but sits underneath modern life like plumbing, logistics facilities that decide whether the shelves are full, whether packages arrive tomorrow, whether companies can compete at all. People think warehouses are easy. Just build more, they say. That's the third illusion. You can't just build a warehouse anywhere and call it valuable. A warehouse in the wrong place is a box. A warehouse in the right place is a bottleneck. And bottlenecks print money. The best logistics sites are near highways, ports, rail lines, and dense populations, and those locations are limited. Zoning takes years, permits get stuck, neighbors fight projects, land costs rise, construction costs climb. Supply is not elastic, it's stubborn, and stubborn supply means rent can climb even when the economy complains. Now zoom out. The world changed when retail stopped being a place and became a process. E-commerce didn't just create online shopping, it rewired the entire path of goods. Everything you click has to sit somewhere close enough to reach you fast. And the closer you get to city centers, the more impossible it becomes to add new space. That's why the warehouse king matters. It doesn't own random warehouses. It owns infrastructure in contested territory. There's another detail most investors miss: the Amazon distraction. Yes, Amazon is famous, but the real story is that everyone else had to copy the model to survive. Walmart, Target, home improvement chains, auto manufacturers, pharmaceuticals, cold storage networks, everyone builds logistics capacity because speed has become a weapon. And when speed becomes a weapon, landlords of the right locations become arms dealers. They don't sell guns, they sell proximity. But engines run hot. The warehouse king's downside is volatility. When rates spike, when recession fears grow teeth, when headlines scream, slow down, industrial rights can drop hard. This is where the case becomes psychological. The public buys growth when it looks safe. They sell growth when it looks scary. Institutions do the opposite, not because they're braver, but because they have a script. Their script says, if the competitive advantage is structural and demand is long run, the sell-off is inventory, not a funeral. Here's the trap. An engine can scare you into shutting it off. When PLD drops 30% in months, your brain doesn't compute future rent streams are discounted. Your brain computes danger. And danger triggers the oldest human response: get out. This is why people underperform. They don't lose because they chose bad assets. They lose because they couldn't tolerate the price path of good assets. So you need a two-part system. Part 1 is the monthly payer, which keeps your hands steady when the market tries to shake them. Part 2 is the warehouse king, which grows fast enough to matter over decades. Together they create something powerful: stability plus acceleration. And now we add the third suspect, the one most people dismiss because it sounds like tech, and tech scares them. The third suspect is not about sidewalks and storefronts. It's about invisible highways, data moving through the air like a second atmosphere. Digital Realty Trust, ticker DLR, the data fortress. If the warehouse king is the backbone of physical commerce, the data fortress is the backbone of digital life. Every text, every video stream, every bank transaction, every AI prompt, everything you do online depends on physical real estate that holds servers, power systems, cooling, and network connections. Data is digital, the buildings are not. And this is where the story gets unsettling. People think the digital world is weightless. It isn't. It's heavy. It consumes electricity. It needs redundancy. It needs physical security. It needs fiber. It needs a grid that doesn't fail. A data center isn't a room with computers. It's a fortress with rules. The tenants don't move easily because moving is expensive, risky, and operationally terrifying. When a tenant leaves, it's not because rent went up 5%. It's because they're changing their whole nervous system. But the data fortress has its own demons: power constraints, build cycles, periods when the market fears oversupply, phases when the cost of capital rises and investors punish anything that needs funding. This is why DLR can look broken in the short term. And that short-term ugliness is exactly what long-term capital often feeds on. The investigation's pattern keeps repeating. The public sees headlines. Institutions see discounted future cash flows. Now we stop telling the story for a moment and we open the evidence bag. Because right wealth isn't magic. It's math, simple math that becomes shocking when you let it run long enough. The engine has 3 gears: the dividend you receive, the dividend growth over time, and what happens when you reinvest those dividends back into more shares. People love the first gear. They ignore the second. They forget the third exists. That's why they never see the compounding that institutions quietly count on. Think of a REIT like a city that pays you rent for owning streets. Your first year rent might be small, almost insulting. But if the city grows and rent rises, your street becomes more valuable. And if every month you use rent to buy more streets, you're not just collecting rent, you're multiplying rent collectors. That's reinvestment. It looks boring. It behaves like a slow snowball. Then one day you realize it's no longer a snowball. It's an avalanche. Here's the interrogation question that exposes weak REITs instantly. Can this company raise its rent checks over time without losing tenants? If the answer is no, the dividend becomes a candle in the wind. If the answer is yes, the dividend becomes a staircase. Realty income is a staircase built on necessity tenants and lease structure. Prologis is a staircase built on location scarcity and logistics demand. Digital realty is a staircase built on the digital economy's hunger for compute and storage. But we don't accept alibis. We test them. Realty income's test is recession behavior. Do people still buy essentials? Do tenants still pay? Prologis's test is supply and demand. Can new warehouses flood the market and crush pricing? Digital realty's test is power and funding. Can the business expand without choking on capital costs and grid constraints? Every great compounding story has a stress test. The mistake retail investors make is they confuse a stress test with a death sentence. Now the 2-decade interrogation begins. Most people can tolerate almost anything for 2 weeks. Almost nobody can tolerate uncertainty for 20 years. That's the real barrier. The market doesn't block you with knowledge. It blocks you with emotions. You can know the math and still sabotage yourself at the worst moment. That's why institutions build process. They don't feel their way through volatility. They execute. So let's build the framework like a detective builds a case. Step 1. Split the $10 into 3 roles. Not 3 tickers. 1 role stabilizes your psychology. 1 role accelerates your growth. 1 role future-proofs your exposure to a megatrend that isn't going away. The tickers can change over decades, but the roles remain. That's how you avoid becoming emotionally attached to a name instead of a function. Step 2. Make the dividend a tool, not a trophy. If you spend the dividend, it helps your lifestyle. If you reinvest the dividend, it helps your future. Wealthy families know this and they don't even debate it. They reinvest by default because their goal isn't a nice year, it's ownership that expands. When your shares increase, your future dividend increases even if the company never changes. And if the company does change, dividend growth, the effect compounds. Step 3. Recognize the villain called checking. The constant price checking turns investing into emotional gambling. You start reacting to noise. You begin seeing every dip as a personal insult. This is how good REITs get sold at the worst times, because the investor wasn't losing money. They were losing sleep. Institutions don't win because they're smarter. They win because they're less exposed to the dopamine trap. Now, the scary truth. The several hundred thousand outcome that people love to hear is not impossible. But it's not guaranteed by simply buying 3 REITs and hoping. That outcome usually requires 1 or more of these consistent additional contributions. Reinvestment discipline, periods of buying during downturns, and enough time for dividend growth to materially change the income stream. In other words, the result is earned through behavior, not guessed through optimism. Ellipsis. And that's where the story sharpens. Because the real conflict is not which REIT is best. The real conflict is whether you can behave like a long-term owner in a world engineered to make you behave like a short-term trader. The market will try to scare you out of your own plan. The headlines will try to rent space in your head. Your friends will tell you it's dead money right before the next cycle begins. The question is simple. When the next shakeout happens, will you sell to the institutions, or will you buy beside them? Every case has a cover-up phase, and in the REIT case file, the cover-up isn't a single villain, it's a system of incentives. Wall Street doesn't need to ban retail investors from good REITs. It only needs to distract them. If you can keep people chasing yield, chasing hype, and chasing short-term price moves, they will voluntarily hand over their best entry points like clockwork. Tactic 1 is confusion. They dress simple cash flow businesses in complicated language until you feel unqualified to judge. They throw acronyms like smoke bombs, FFO, AFFO, NAV spreads, cap rates, implied caps, debt ladders, cost of capital. Most of those are useful, but the way they're presented is often designed to do one thing: make you think you need permission to invest. The truth is you can start with 3 questions. Is cash flow growing? Is the dividend covered? And is the balance sheet survivable? Tactic 2 is fear. REITs are just interest rate plays. It's a seductive simplification. Rates rise, REITs fall, end of story. Except it's not the end of the story, only the beginning. Rates are a headwind, yes, but rent growth, occupancy, and property quality matter more over long periods. Fear messaging is useful because it pushes retail investors into short-term thinking. And short-term thinking is how you sell at a discount. Tactic 3 is the most insidious, spotlighting the wrong REITs. The loudest names on TV are often the shakiest ones: high yields, leverage, fragile tenants, or sectors that can't raise rents. Why? Because volatility creates clicks. Boring compounding doesn't. The institutions don't want you competing for the best inventory. Because more buyers raise prices and reduce yields. So the public conversation stays focused on the loud, not the durable. This is where yield bait enters the room. Yield bait is a dividend so high it feels like a shortcut. But yield is not a reward for your intelligence. It's often compensation for risk. The market doesn't hand you 10 to 15% yields out of kindness. It hands you that yield because it suspects the dividend is unstable. The asset is deteriorating, or the debt is dangerous. The bait isn't the dividend. The bait is your impatience. Here are the red flags you watch like a detective watches a suspect's hands. Payout ratios that are consistently stretched. Heavy exposure to one weak tenant. Short debt maturities stacked in 1 or 2 years. Repeated equity dilution without per-share growth. And management adjustments that keep painting over reality. A REIT can survive one problem. It usually can't survive 5 at the same time when the economy tightens. Now, back to our 3 suspects, because they're not innocent angels. They're just higher quality. Realty Income's risk is that retail narratives can change and rate cycles can compress valuations. Prologis's risk is that a global slowdown can freeze leasing and scare investors with sharp drawdowns. Digital Realty's risk is that power availability and capital costs can squeeze returns if execution slips. The difference is that these risks are visible and manageable, not hidden landmines. The real reason quality matters is because time is a harsh judge. Over 20 years, mediocre assets don't just underperform, they expose you to permanent loss through dividend cuts, dilution, or bankruptcy. Quality assets may fall, but they tend to recover because the underlying demand remains. That distinction is everything. Your job isn't to avoid drawdowns. Your job is to avoid permanent impairment. Let me show you how institutions think during panic. When prices drop, they don't ask, "What if it goes lower tomorrow?" They ask, "Has the long-term rent engine been damaged?" If the engine is intact and the price is lower, the expected future return is higher. That's not bravado. That's arithmetic. Panic is when future cash flows get discounted harder than reality deserves. That's when long-term buyers quietly add. And here is the emotional twist most people don't see coming. The moment that feels like failure is often the moment you're being offered your best deal. The monthly payer trading down because rates jump. The warehouse king selling off because recession headlines spike. The data fortress getting punished because capital looks expensive. Those are not always warning signs. Sometimes they're invitations, if, and only if, you can keep your plan intact. The future chapter starts with a quiet problem the headlines still underestimate. Electricity is becoming real estate. Not metaphorically, literally. The data fortress doesn't just rent square footage. It rents power, cooling, and uptime. As AI models grow, training and inference stop being software and start behaving like industrial demand. The world will talk about AI like it's a cloud in the sky. But the truth is it's a furnace on the ground. And whoever controls the buildings that can feed that furnace controls a toll road on the next decade. This is where many investors get spooked the wrong way. They hear data centers and imagine unlimited supply. Just build more boxes. But you can't build your way out of power constraints overnight. Permitting, grid upgrades, transformer backlogs, land close to fiber routes, local resistance, environmental approvals, these are slow gears. And slow gears create one of the most underrated forces in investing. A demand curve that moves faster than supply can respond. Which is exactly how landlords quietly gain pricing power while the public argues about narratives. Meanwhile, the warehouse king is facing its own version of scarcity. The best logistics land is not replicable. You can build a warehouse far away, but you can't manufacture close to ports, close to city centers, close to highways, close to labor pools. Those sites are finite. And governments don't hand out zoning approvals like candy. This means the real competition isn't between warehouse owners. It's between tenants fighting for the same irreplaceable locations. And that tension tends to show up in rent growth over time. The monthly payer, on the surface, looks the least futuristic, which is exactly why it survives eras. People still need medicine. People still buy essentials. People still repair homes. When the economy gets nervous, the demand for nice to have disappears first, but need to have stays. The subplot most viewers miss is that stability becomes more valuable when the world becomes more unstable. Stability isn't a lack of risk, it's a resource that lets you hold your position when everyone else is forced to sell. Now we talk about the next reset, the event that always arrives on schedule. Just not on a calendar. Real estate cycles don't end because someone announces them. They end because debt matures at the wrong time. When refinancing gets expensive, weak balance sheets snap, properties change hands, great assets get repriced because the owner needed liquidity, not because the building became useless. And that is the moment the right story repeats. Distress creates inventory. Inventory creates opportunity, and opportunity transfers future rent streams to whoever has patience and cash flow discipline. I've seen this pattern in every normal person's portfolio too. The reset doesn't always come from the market. Sometimes it comes from life. A job change, a medical bill, a family crisis, a panic decision. The difference between the retail investor and the institutional investor is often one simple thing. The institution has a rulebook that doesn't care about feelings. The retail investor improvises when fear arrives. Improvisation is expensive. So here's the discipline ritual, the part that turns this from a story into a system. First, you automate your contributions on a schedule you can survive, not a schedule that impresses people. Second, you automate reinvestment, because willpower is unreliable and boredom is your friend. Third, you set a panic protocol in advance if prices fall sharply and the underlying rent engine is intact. You do not sell, you either do nothing or buy modestly more. The protocol is not about being brave, it's about removing decisions during emotional storms. Then you add the detective habit, one check-in per quarter. Not per hour. You don't stare at price, you read the case notes. Occupancy, rent growth, dividend coverage, debt maturities, tenant concentration. If those remain healthy, the headline noise is just weather. If those break, you don't panic, you reassess. This is the professional move, calm evaluation instead of emotional reaction. Most people don't fail because they lack information, they fail because they consume information like entertainment. Here's the twist that makes the ending believable. The $10 isn't the hero. Time is the hero, but only if you don't betray it. Compounding is loyal to those who are loyal to it. It rewards consistency more than genius. It punishes impatience more than ignorance. And the market will test your loyalty with scenes designed to make you quit, drawdowns. Scary headlines, friends bragging about faster wins. Those are not random, they are the toll gates on the road to long-term ownership. In the next chapter of our investigation, we're going to map the two-decade blueprint, like a crime scene diagram, how the three roles work together. How rebalancing prevents one engine from dominating your emotions, and how a simple monthly habit can quietly build a portfolio that pays you even when you stop working. Because the real goal isn't to be right this week. The real goal is to own cash flow machines long enough that the world's chaos becomes background noise instead of a threat. 20 years pass in the story faster than they do in real life. But the feelings arrive on time. The investor who started with $10 doesn't wake up one morning rich. The change is quieter. One day they realize they're no longer afraid of small disasters. A car repair becomes an annoyance, not a threat. A surprise bill becomes a line item, not a panic attack. That's the first real dividend, the psychological one. And it's the one nobody puts in a spreadsheet. The second dividend is the one you can measure. The income stream that used to look tiny now looks different because it isn't coming from the same number of shares anymore. The shares multiplied in the background, month by month, quarter by quarter, through boring reinvestments that felt pointless early on. The investor remembers the first year, how the dividends barely bought a decent dinner. Now the same machine buys time. It buys breathing room, it buys choices. But the scene that proves the whole case happens during a downturn. Not a boom. A year like 2022 repeats again in some new costume. Rates spike. Headlines get loud. Prices fall hard. Friends say, REITs are dead. Commentators say, why would you own these when you can get yield elsewhere? The investor feels the old fear wake up. Then they look at their protocol. They check the case notes. Occupancy is still strong. Rent growth is still there. Dividend coverage still holds. Debt maturities are managed. The engine is intact. So they do what most people can't. They don't flinch. Buy a little more. Not because they're fearless, but because they're trained. The monthly payer steadies the mind. The warehouse king keeps the growth story alive. The data fortress keeps the future exposure meaningful. The market offers discounted ownership. And the investor responds like an owner, not a tourist. That single behavior, repeated a few times across a couple decades, is often the hidden difference between a portfolio that merely exists and a portfolio that actually changes a life. At some point, the investor stops obsessing over the share price and starts thinking in rent units. How many dollars of annual income does my portfolio produce? That switch is subtle but powerful. When you think in rent units, volatility loses its teeth. A price drop becomes an opportunity to buy more income for the same dollar. A price rise becomes confirmation that the market is revaluing what you already own. Either way, you're not trapped, you're positioned. The final revelation of this case file is simple. The greatest advantage institutions have isn't inside information. It's that they understand what they're buying. They're not buying tickers, they're buying contracts, locations, tenant behavior, and time. They don't need to predict the next quarter perfectly. They need to avoid permanent damage and keep compounding alive. Meanwhile, the average investor keeps getting distracted by noise, seduced by yield bait, or scared by a chart that looks like danger when it's really just discounting. And this is where the story circles back to the beginning, to that table in the late 1960s. To that boring, legal document that quietly opened a locked room. The room is still open. The doorway is still there. But the guards aren't standing at the door anymore. They're standing in your mind. They whisper that you need to be smarter, faster, richer, more sophisticated. They whisper that real wealth is made through secret moves. But the wealth in this story is made through something almost offensive in its simplicity. Buy quality. Reinvest, hold, repeat. If you want to change the ending of your own financial story, it won't happen through one heroic trade. It happens through a small decision you can make today. Then a system you refuse to abandon tomorrow. Automatic contributions, automatic reinvestment, quarterly check-ins, a panic protocol written when you're calm, not invented when you're scared. The system is the hero. Because you are not always going to be strong. The system carries you when your emotions would otherwise pull you off the path. Picture the last scene, the investor, older now, watching the same world that used to terrify them. Markets still crash, headlines still scream, friends still chase shortcuts, but the portfolio keeps paying. It doesn't care about the noise. It doesn't ask permission. It simply does what good real estate has always done. It collects rent. And the investor finally understands the difference between being impressed and being free. Flashy wins impress people. Durable income frees them. Here's the final question of the case, your case. When the next downturn offers you discounted ownership, will you react like the crowd? Or will you respond like an investigator who understands the machine? If this story flipped a switch in your mind, subscribe now, because I'm building more case files like this, boring strategies that quietly beat flashy fantasies, and simple frameworks that help you stop losing to your own psychology. And if you want, I'll show you how to build a personal, right protocol, tailored to your income and timeline. So you don't just watch this story, you live the ending.